Hi, everyone. I'm DeFi Dad. You're watching episode 28 of Yield TV. Michael, every time I hit that live button, I also you can see me on screen trying to just say what I'm saying, but really I'm trying to make sure I press the right clip button. Like one of these times I'm going to, hit the Borat clip on accident. So anyway, hi, everyone. It is November 9th, 2020, and today we're going to talk with Michael Dunworth of Wyre. So Michael is the founder CEO of Wyre, which is sendwire.com. That's W-Y-R-E, if you've never tried it and are living under a rock. They build powerful but simple payment APIs for crypto applications. So you've probably used Wyre in one of many DeFi applications like the Argent wallet, Dharma's wallet, Pull Together, and many more. And so I got familiar with Wyre in the last few years because not only was I one of the folks who had used Wyre to get my fiat into the crypto ecosystem, but I also used to listen to your podcast series, Wyre Talks. And anyways, I actually first heard, I think it was you, Michael, on one of your podcasts talking about this zero to crypto in 20 or 30 seconds. So we're going to talk all about that today and how Wyre has been enabling fiat on-ramps for DeFi applications. And one other note, Michael is one of the earliest investors in Zapper. So curious to kind of talk to you more about your investment early on in Zapper. And thank you for believing in us, I guess, before anyone else did. And also want to talk to you more about your investment theses since you are an angel investor in the crypto space. So on that note, Michael, welcome to Yield TV. How are you doing?
Good. Thanks for having me.
Awesome. So you were just saying you just got a COVID test?
Yeah. Like I've been just bedridden for like a week. And then I was like, I actually went somewhere. I went to like the gym or something and they were like, oh, you sound really sick. And I was like, oh, I'm really sick. And they're like, have you had a test? And I was like, nope, why would I do that? And then sure enough, I went and got a test and it came back. Oh, we were joking. It came back positive, but no, it's negative. So
this is going to be like, they're like, what is the matter with him? The sick person. He's like, oh, Michael, I think you got a COVID test. And what they missed is before we went live, I said, oh gosh, are you okay? And you were like, yep, I'm positive. And I'm like, oh my God, what? Like, I feel badly we're doing the interview, but.
No, it's all good. Got a COVID test. And you know what's weird with the COVID test? How they're like, we were talking about this earlier. So for those of you who haven't had a COVID test, it's basically something like up your nose, like into your brain, and then something down your throat, like into your stomach. And they're like, I'll just tilt your head back and you're like, yeah, sure. And they're like they just drive this stake in your head. You're like,
So my son is about 4 and he got tested. We live on the East Coast now, but we moved. And when we were moving, we had to get a COVID test to be able to fly. And, he's little. I mean, he's, if you're 3-4 years old, you're sitting in a car seat. So we go through this drive-through for him to get tested. We roll down the window. The nurses were very nice, but still they look terrifying because they're covered in all of the protective gear. And
looks like they walked out of Chernobyl.
Yes, yeah. And my son was actually okay up until they shoved this thing up his nose. And when they did it, he, of course, screamed uncontrollably. But then when she pulled it out, he's so little, like, it's not like he's stringing together like soliloquies and paragraphs. He looks at her and he goes, ouchie! like you idiot.
It sounds like the reaction I had.
Yeah, just hilarious. But yeah, so Michael, we'll cover really your journey building Wyre today. I want to talk to you more about your theses on the DeFi space because you sit in this interesting hybrid position. Wyre is a traditional fintech company, but you're plugging in with your API into all of these decentralized finance applications. So I've always kind of wondered like how you guys see yourselves as like a bridge between what like Silicon Valley fintech is and what DeFi is. And then also just want to talk more generally about your theses on the crypto space, because you are one of the few people that I know personally that is also very bullish on Bitcoin and Ethereum. So we tend to bridge the tribes, and yeah, exactly.
So much tribalism.
Yeah, would love to dig into that a bit more. But why don't we start with some of the let's start from the beginning with Wyre. How did you found Wyre, and what was your journey, I guess, up until founding Wyre?
I worked in like a bunch of places, but I was working in financial software before Wyre, and I moved over to San Francisco in 2013, where I met my co-founder Yanni in a hacker house, and we actually started it sort of by accident. It was a browser extension at the time, similar to Lolly, like so where you'd shop on places, and then basically you would spend. Well, Ethereum didn't even exist at the time, so you'd spend Bitcoin, and we would act as a way for people to spend their Bitcoins at different places. And over time, we became more and more understanding of the regulatory component and all that stuff. So we started getting licenses and doing all this heavy lifting, and then that's when we were like, we felt that the most value that could be added was us making sure other people don't have to do this, because if everyone has to go and get all the licenses and do all this shit, it's going to slow down the evolution of the industry. So we were just like, all right, well, unfortunately, this is what we're going to do. There's a lot of cooler things we could probably do, but this is what's needed by us. So we were like, people say that it's sort of like, people get licensing for a moat, like, defensibility. We probably sell the moat to everyone.
Interesting.
If that makes sense.
Yeah, interesting. Okay, so tell me more about like what was the journey like, I guess, building Wyre like the last few years? Because I mean, for a while there, like I know when I joined the crypto space, I was thinking more about just I'm going to buy and hold, let's say Bitcoin and Ether. I might hold it in a at the time, really, it was actually just holding it in like something like MetaMask or maybe like a hardware wallet. When did you start to see light in terms of applications that you could power and, in other words, make Wyre that much more valuable to the community?
Well, I mean, it comes down to what everyone needs, like what's the problem that you're trying to solve. And I think it's just, you can't I think one of the questions was, what was missing in the community that we were talking about. I think it's like, you can't fight time, and everyone's sort of trying to expedite things in this less organic way. So one of the things I said to our investors about 3 years ago, I said, look, this is how it's going to unfold. We can't expedite it. So it's sort of, when I say expedite it, I mean, hey, we've got 1 million users today. We need 2 million users by the end of the year. You can't make that happen. All you can do is wait for them to come and build as much as humanly possible that adds value to them, so that when they come for a bull market, they'll stay for X. So come for the price, and then they stay because, I can earn interest, or I can take out a loan, or all this sort of this environment that's, can do like more enticing for people to keep their capital in crypto denominated products, whether it's stable coins, Ethereum, or Bitcoin. And so for us, we were like, okay, let's just get to work on making the plumbing as much, like giving everyone the best chance of success. So, if we look at DeFi as like money Legos and stuff like that, we try and take this compliance regulatory burden, which is like it's sort of like a really boring part of the Lego pieces, but it's necessary for teams to move forward with confidence that they're doing the right thing, and they're not sleeping with one eye open because they're not sure if they're regulatory, like if they've got compliance intact or not. I don't know if that makes sense.
No. Actually, I want to take a step back further, because I always am fascinated how all of us, anyone in general gets into crypto. So do you remember what drew you into Bitcoin and Ethereum? Like those are two very different places at different points in history. Like, do you remember like what was lighting up the light bulbs in your head about like, whoa.
So Bitcoin was sort of like, it was really early on, and it was like sort of an accidental thing, sort of fell into it. Just as like, someone was talking about buying this cool internet currency at the time, and we all chipped in to like buy some of it. And that was sort of like 2012 or 2013, and then Ethereum came around, which looked really exciting. I think I probably got on the Ethereum train a little later, so I remember messaging like our team when it was like $5 or $2 or something, saying this thing's about to go like on a rocket ship. Everyone should buy and hold for 18 months, I think I said. And then sure enough, like it just went crazy. Like Ethereum just enabled, it satisfied a lot of developer appetite that wasn't being satisfied by Bitcoin. Not in a bad way, but more in a, like, they're two different things. And I think Ethereum came to solve a different problem than Bitcoin was solving. And so that was super interesting. And we sort of, like, as Wyre, like being the plumbing, connecting, like if you want to enable developers to build powerful applications, we have to look at things. We have to be in an agnostic position. Like, so I can have my own personal preferences, but for the better of the community, we can't really bring my personal preferences and say, everyone think like me and fuck off if not. Pardon the language. But it's got to be like, we've got to be enabling everything to happen and see what sticks. And so, predominantly Bitcoin sort of like the heavyweight when it comes to that from our side. But obviously there's Ethereum creates all these DeFi protocol, like DeFi applications. And I think in time we'll see them all, like they all rely on one another. So not only the Ethereum ecosystem, but Bitcoin and Ethereum are very reliant on one another.
Yeah, I mean, we've already seen just this year, tokenized Bitcoin has exploded now on Ethereum. That was something a year ago that was still promising. And I think we were all excited because there was quite a bit of wrapped Bitcoin, despite the, I think we all know, like, wrapped Bitcoin, it's kind of like Tether, like everyone uses it, but then like outwardly criticizes it. So anyways, we've come a long way though. Like now the ability to tokenize your Bitcoin into Ren BTC, that blew my mind. That was a big moment
cool
for me.
Yeah. And now you've got Keep as well. Keep's out with, TBTC. Yep. I think it's super exciting. And like at the end of the day, you've got to add value. And like you talk about Tether or wrapped Bitcoin, whatever it is, like people are trying to say, why aren't people using it? It's like, well, you've always got to add value, and value is going to be whatever makes someone get off their ass and go do something. Like, so people talk about like getting into crypto is hard. It's like, well, no, you just haven't given them a good enough reason to do it. And when you think about what got you into, let's say everyone's like, oh, it's like a smartphone revolution. Great. Well, almost every single person had to go to the Apple store to buy a smartphone. And most of those people lined up to buy a smartphone. They have to get out of bed, walk down the street. So if you tell me that buying crypto is more difficult than that, I would be hard pressed to believe that. And so people don't make the right comparisons, but because an iPhone is really valuable to me or whoever, I'm going to get out of bed, I'm going to get changed, go have a shower, and I'm going to drive to the Apple store and go buy one because I know what I'm getting in return for that work that I've just done to get there, and the money that I've paid is going to be worth it. So it's adding enough value for me to be compelled to go and buy one. And a lot of the times in crypto, people don't think long term. They think very short sighted, which is why you get early ripe, early rotten scenarios where instead of having like MakerDAO, right, is this behemoth that they've been going since 2015, very methodically linear growth where they're not trying to explode in 2 seconds. Now they have exploded, but that's sort of a later result of all this organic growth. But then if you look at a lot of these like DeFi farming, like the farming strategies and stuff, they're wondering why they become boiling hot one day and freezing cold the next. And the reason is because people come, and the target customer that you attract when you do something like that, it's like putting it's like selling clothes at a clothes store and putting a 90% off sale and then having everyone come in, take all your stock, and then asking them to come back weeks later when everything's full price. It's a different demographic that's being targeted. And so I think if people got out of the mindset of we need something now, and they really thought long-term about user retention, they'd be so much better off. But it's it's like a poison apple in a sense. Like it's hard to resist this, you know, flood of liquidity, flood of users, flood of metrics. So I get it. I just, yeah, I think it's sometimes a little less advantageous than some people think. That's a really long answer to a question that I don't think you even asked.
No. There's a lot.
Sorry.
No, not at all. No, Michael, you're covering a lot of ground where, you know, we think about who is the person who is most likely to benefit from the value that we offer. And that user, it can be very different for Wyre versus like an Argent wallet versus someone using a Bitcoin to escape some authoritarian regime. And this is one of the things in our community, because people have such passionate, such like strong opinions about
dogmatic.
They're very much convinced that the world will adopt this. But what you have to do is you have to talk to people on the ground level. And that ground level could be someone who is very, very wealthy, who is ready to throw money into the crypto space because they see opportunity to speculate. But then there's others, you know, we're excited about like, how can someone who has some awful fiat currency that is causing them lots of strife due to inflation, how can they just simply use stable coins and a wallet? And I mean, when I think about like Wyre, I think about the fact that at least my experience had been that we have this very like financially literate audience in the DeFi space right now, and they want to get fiat into like a DeFi application. So they're okay to go through like a KYC process with Wyre, especially for those of us based in the United States, because it's quicker, it's easier than maybe me going through an exchange. What do you think is the user profile, Michael, or what are the user profiles that interest you the most? The ones that are enough on the fence, but you think we can tip them in, you know, the next year or so to actually start using decentralized finance or crypto applications?
Yeah. So I think there's a couple. And this is sort of, you know, I was saying this to our team last year, and I know that we've been doing a lot of work this year to sort of in preparation for it. But, you know, essentially when you have bull markets, so we're in a bull market now, things are trending upwards. And a bull run happens. When a bull run happens, you have people want bull runs cause volatility. Now, volatility is what traders want. So if there's volatility naturally in the market as it's going up, you don't have as much room for derivatives. So derivative, 100x leverage, 20x leverage, all that kind of shit. That thrives in a bear market when there's not much volatility, because someone if it's only moving 0.5% per day, they can do 100x leverage and make that, you know, 50% volatile swing per day. So traders look at that. Now in a bull market, because there's already volatility, people want savings. And so that's basically security, and yield is a bonus. So it'd be security first, or like acquiring the asset, securing the asset, and then generating an alpha, or like a yield on that secured asset. So for me, I think about savings as probably being the biggest over the next 12 to 18 months. Mainly because you're going to have a lot of people come in. We've already seen a lot of people building applications that are taking the yields that are possible in these open systems, like, you know, whether it's crypto related, like all these crypto related yields, right? Whether it's earning interest on stable coins or Ether or whatever it is. That's really becoming prominent, and that will become prominent. The more bull run we have, or like the more of a bull market we have, the more people are going to want to secure or just generate savings. So derivatives, I think, is like, it's still going to be there, but it's probably not going to be as big. So yeah, I see that. So the people that are depositing $100,000 and that's getting converted into USDC and then generating a yield, it'll become like a savings account. I think Outlet.finance, I think Linen, those guys are sort of abstracting that, where you connect Plaid and the money just shows up earning 5% interest instead of, let's say, 0.0000001% or whatever Bank of America uses. So I think there's sort of these crafty ways, but I think that's a big one. And I think you'll see a lot of So that's from like a retail person, or like a retail investor, maybe a high net wealth individual. I think you'll see all the treasuries of the crypto teams explode. So all these teams that have 100,000 ETH, 200,000 ETH, or 1,000 Bitcoin, that's all going to 10 or 20x over the next 18 months. So
Yeah.
you've got teams that have got $500 million in assets under management, and that's going to grow to $5 or $10 billion worth of assets under management. So these teams are going to need they're going to need to put that to work. So you're going to have very crafty on-chain strategies that people are probably renting out to each other. I'd say.
Yeah. Gosh, I haven't talked about these sorts of things in so long because we've just lived through the bear market forever. And yeah, I also believe that we're now in a bull market. All signs point to it. This drawdown over the last few months, which really has been juxtaposed against Bitcoin surging, and I'd say Ether holding, but also me following Bitcoin. It seems like we're finally living through a different phase of crypto history.
It's beginning.
Yeah. So that's interesting that you were pointing out how derivatives would do better in a bear market, which actually was my experience as well. I definitely discovered leverage during the bear market. Spent a lot of time thinking about how can I possibly short? How can I do what little is possible right now? Since when you're in a bull run, it's just easier for folks to be holding onto assets and watching them go up. I think sophisticated traders out there that can actually short a market, they're in a much better place. I am curious though, there's so many new DeFi related derivatives. We have options now with Hedgic and Open.
Didn't Hedgic get hacked a month ago or 2 months ago or something? Or was that someone else?
A while ago. They had actually Open had some sort of a bug.
OPYN. Oh yeah, OPYN. Yeah. Okay.
Sorry. Yeah, I think it was Open a while ago. Hedgix goes back to the spring, and it was a bug where LP funds got locked. I think it was about $40,000. Interesting because I remember the whole space erupting over it, but then it was this is nothing compared to what we've seen happen. And I get happy to report both Hedgic and Open are seemingly doing really well right now.
I think so too.
What do you think of options though? We've got DYDX still and MCDEX and Future Swap soon. They all do 10x leverage for perpetuals markets. Can these products grow substantially during a bull market or?
Yeah, they can, but again, it's not my opinion. I don't think. It's more just look at the underlying mentality that comes into a bull market and bear market. I'll give you an example. So currency trading, which is hyper liquid. You're trading the euro to GBP or something. Mm-hmm. They trade it with 100x leverage because it's so tight. The markets are so tight. There's no volatility. So they need to manufacture the volatility by saying, right, if it only swings 0.01% a day, I want to do 100x leverage so that any swing becomes a 1% swing. Now, if you've already got these swings going crazy in the market by default, which we will have, it then becomes more expensive for you to, the more volatility, the more ambiguity, the more expensive options and derivatives would be. So it probably becomes more expensive than buying the spot market. So I think that while they're going to be really good products, I have a hard time seeing them outplay the core products of just wallets, savings, and those kind of primitives. I feel like they will come after, and they will be huge. Look at BitMEX. BitMEX wasn't BitMEX until after the bull run for the most part. BitMEX became BitMEX at the end of 2017 or later 2017, and then all 2018, 19, and 20. And that's because they offer 100x leverage. Binance out sort of outpaced Coinbase because they didn't have derivatives, but like, I mean, sort of at the time, the speculative amount, the amount of assets that they offer. So instead of having derivatives, you can just offer more risky assets and get that same target demographic of a trader who's trying to play on the volatility. And so listing more assets becomes like, obviously it's sort of like more like a casino, but at the end of the day, it's the way people get volatility. MakerDAO is very successful over the bear market, as was Compound, because they offered an opportunity for people to, like when MakerDAO launched a CDP, I could lever up my asset and put it to work a bit more. And so now you saw sort of like rolling into 2020, the DAI savings rate started getting rolled out. And now while it's not there at the moment, it'll come. Like it's a long play, but I don't know if that makes sense.
It does. It's a really easy explanation, actually. And I've never thought of it that way, but I think you're describing the reality that I've witnessed, which is, like you said, you can't, you're not going to stay in a market if there's no volatility. And so what we lived through in 2018, 2019, you saw like Bybit was a really big derivatives platform that launched, and very similar to BitMEX. Basically, all of these competitors to BitMEX became more and more popular. And now we're at a point where we're kind of getting back to more of like the basics, because the basics too makes it easier for people to participate. At the end of the day, like we go through these speculative bubbles, and those speculative bubbles bring in more people, and more people stick around. And so, yes, we lose some folks, like, none of us are wishing for people to lose money, but it drives interest. I mean, at the end of the day, it's a fear and greed cycle that plays out over and over and over again.
Basically. And I mean, like that's what happens. And it happens every 4 years. And people say that it's not like clockwork, or it's like clockwork. And you can write it down every time. But basically you have a halving, like for Bitcoin, right? Bitcoin's always going to be the beachhead. It's not a dogmatic opinion. It's just the nature of liquidity and depth. So each person that comes in, for the most part, they're going to start at Bitcoin because it's the most simple. It's obviously, from a brand perspective, it's the longest running, but it's just a simple thing. It's a store of value, and that's sort of the value prop. So people think it's digital gold. They come in now when that goes 4 or 5x. So people that bought it at, let's say, $2,000 or $3,000 in 2017, they're up 6x now. So they're going to think, hey, I'm a genius. I'm going to put some money to work in other areas. And they're going to start going, if they haven't already, into Ethereum and then into other DeFi protocols and whatnot. Because this is what drove the 2017 bull market, is that this explosion in profits from people that bought in Bitcoin at 200, 400, 600, they're getting 10, 20, 30x multiples on their money. They're ready. And the Ethereum people that bought in the ICO or whatever, and that's gone to $90 or $250.
Yeah.
They're up like 300x. So they can say, imagine being up 300x. That's like investing $100,000 and being up 300 times. That's like $30 million or something. Or is it? No, 300 times. Yeah, $30 million. And saying, right, I invested 100. I'm going to put $1 million. I'm going to put my $100,000 back in my bank. I'm going to take $1 million of that, and I'm going to sprinkle it across all these different ICOs. Yeah. And now you're hoping that one of them hits home. So that's going to, like, do you know what I mean? Like, it's sort of this overfilling, sort of like these reservoirs that spill over into one another. And I think you'll see the same thing with Bitcoin. At least, like, Bitcoin will do that, and then Ethereum will pop. And obviously, the more illiquid it is, the more it's going to slingshot like up and also crash, which is interesting to sort of watch. Shit, what was the question originally?
No.
Sorry.
No. You're helping to explain. I think for anyone that would be newer to the space, or even those that like hadn't lived through like a full bull to bear cycle, like you have to understand that you see a return on these like core blue chip assets like Bitcoin and Ether, and then yes, you see that spill over and reallocated to other tokens. And I guess then, I mean, while we're on this, because like this is really interesting, versus I actually want to go deeper with some of these investor theses. If you look at the past summer, how do you rationalize that then with what we just talked about, these bull bear runs and reallocating profits into other tokens. Like, what was the DeFi summer? Because I think I asked that because I watched it and was like, I feel like I'm watching like a mini cycle, like where some people got up on a number of different core investments and like really like more obvious DeFi tokens. It got reallocated to more risky assets. We saw a lot of volatility, and then it seems like we're now consolidating. You know, we're seeing money move into whatever blue chip DeFi is. You know, we saw it move into Bitcoin. Actually, we saw it move into Ether, and it seems like, you know, you look at the tokens like Aave. Aave is one of the leading DeFi related tokens. Anyways, Michael, how do you like rationalize the summer?
Well, I mean, obviously there's a lot of excitement, so everyone gets excited. That's good. You know, you don't want to. So I'm just bringing up DeFi Pulse now, just to check it out. How good is DeFi Pulse, by the way? So Uniswap sitting at 3 billion asset stock, Maker, WBTC, Compound, Aave. Okay, so there's a couple of things that happened. One, everyone was doing ICO. Oh, nice. Okay, sweet. Everyone was doing, I won't say, they were doing token launches with liquidity mining. So Compound was the first, I think. Like at least like that. Let's think of Compound as sort of the initial one. That drives a lot of capital to be locked up. It chokes supply. It does all these sort of things. Now, Compound's release cycle was sort of incentivizing this crazy aggressive behavior. I think around the time Compound listed Tether. So if I was to chalk up what happened, like why did DeFi explode?
That was it.
Compound listed Tether. There's a huge liquidity opportunity there, just by the nature of it's the #1 most traded asset in the world in cryptocurrencies, more than Bitcoin, more than everything. And that's because it's everyone pegged back to Tether because it's the most liquid. And sort of that's sort of the thesis why Curve is very successful, is because it creates liquidity for stablecoin. So you've got Compound yield farming, and then that coupled with Tether bridges more liquidity into the ecosystem, and you can put more to work. Coupling that with Ethereum running from 265 or something up to 420 or over 400, like sort of these perpetual cycle, infinite loops of just going round and round. Uniswap launched, that injected a whole bunch of free money to everyone. I think a lot of people sold it and put it to work different places. Absolutely. Most of it comes down to yield farming, and I think a lot of the yield farming comes down to people just launching new tokens. Balancer launched one. I feel like I'm missing something here.
No, I know there's so it's like you could tell a story about each of these, and really Synthetics before that was leading with liquidity mining. Like that was the early program, and it's funny
on Uniswap and that was like Zap. I remember. I think that was the first one that I'd ever done. They were like, they're incentivizing people to use their protocol, and I think like Synthetics is. I think they're awesome. I think they are so. They've done such good work, just executing and adding value. Like, what does the market want at the moment? Let's figure out ways to get it done. And just a really good community management. I think Kane and Jordan and the whole team have just absolutely killed it. I don't know. It's kind of weird, but if you look at why a lot of these things sort of blew up and then cooled off, it's because everyone was excited about where's the free money now, and they were looking for that alpha, not long-term stuff. So you have let's look at Sushi Swap. Let's look at all these different farms and programs. They're great, but the problem with those is that whoever is coming to use your protocol are coming for the wrong reasons. They're coming to exploit that alpha and then fuck off to the next, wherever the next venue is, that's not a problem. But if I'm running a protocol, I want resiliency for the long term, because I don't want people to come and then piss off. I liken it to Groupon. So Groupon is a great way to get 1,000 customers into your store selling if you sell cupcakes. But every single person that you get from Groupon is, not going, I mean, not, but they're probably a bargain hunter, not going to be running back to your store to pay full price. So it's kind of like, that's how you get this early ripe, which is my store is full of people, to an early rotten situation, which is where did all my customers go? And so that tends to happen when there's, you know, sort of like a zero sum, I wouldn't say zero sum, but I'll say like these short-sighted strategies. But time will tell. I think time sort of tell because there's a bit of a DeFi hangover. But yeah,
it's been
does that make any sense?
No, I think you're calling out the fact that the summer showed us that, you know, it was easy for us to move our money from one protocol to the next. And so we saw everyone get excited to move from like a compound eventually into Yearn. Like we all forget Yearn, Wyre as a protocol did not exist months ago. And then folks moved on to at some point, I think Sushi Swap was definitely like, to me, like
Yams. We totally forgot about Yams.
Yams, another one. Yeah. You see liquidity moving around, but at the end of the day, when you look at DeFi Pulse, it kind of looks the same as when we started, except everything has grown. Like, you know, at this point, we grew from like less than $1 billion in January 2020 to now we're well above 12 billion, closing in on 15 billion. So, you know, the fundamentals do matter. People stick around because Compound is secure to use. They stick around. Synthetics has on-chain exposure to any asset. They stick around with Aave because Aave is incredibly quick to iterate and provide one of the best user experiences.
Exceptional. Yeah.
It's
and so just to speak to that point, because it's sort of like what we were talking about earlier, where you sort of say like, who are the ideal customers, or like who are the target customers. But so just to your point, right? So DeFi right now, I think it's probably like 12 billion in assets under management or something like that, total market cap. Now you said it was less than $1 billion. Now I'd attribute a lot of that growth as well to the growth of Ethereum, because now that you have derivatives, Ethereum can grow 3x. And if you've got a lot of places where people are trading, like let's say CDPs and stuff, people can increase their exposure. And obviously these are very well-educated people in terms of I don't want to say that as a blanket statement, but a lot of the people know the space pretty well. So I feel like, you know, having 12 billion in AUM, that's an example of this growing the pie while the whole pie is actually growing. You know, it's like exponential growth. So it's like more people are coming in, but also the pie is growing for all these treasury teams. So I think it's super exciting. I think it's definitely a lot of people underestimate the longevity and the long-term approach. Like they're very concerned about tomorrow, this month. Oh no, we've got to launch this month. Like, I mean, like we were talking, I don't know if it's sort of like we're talking about obviously Zapper, and you know, you guys have to integrate, you know, a new one every other day, and you guys have such a fast cycle. It's so impressive. But the problem, not the problem, but obviously it's, you know, that comes to an end. But the Zapper clientele, when I was talking to Nodar about it, like maybe like a year ago, we were talking about like who they were, and it was sort of at the time people using BZX or this thing because they need more. Like they bought crypto and leaving it up. They bought crypto, leaving it up, and it's like, what's next? And so, that target demographic, they're so far ahead of the sort of the like the average Joe user, and I found that really interesting to see what limits and like what boundaries you push, and that's where like a lot of this yield farming stuff comes in, because I mean, effectively, yield farming is liquidity mining is sort of like wash trading, but you're paying fees like on a central exchange, but it's wash trading for a protocol almost. I have no problem with it. I don't like, no big deal to me. I think it's cool. I think at the very least, it helps people understand and learn more about obviously cross protocol trading. It helps them understand products better. And yeah, I think any incentive that educates people is always awesome. That's why I've always thought like you guys do such a good job with like just educational content. It's so helpful. And remember, it's going to last forever because
it
people are
matters.
going to come into space in 10 years. They're going to come into space in 6 years. Like you go on YouTube, you can see videos that are 8 years old. This is going to be the same thing. And it sort of sits in the archive.
Yeah, the interfaces could change, but a lot of the lessons are there. Something else you were calling out, though, I've also heard, I think it's Santiago Santos is his name from Parify. He was talking about he was saying that liquidity mining is almost like an customer acquisition cost, but you are like issuing, essentially a voice in the protocol, and unintentionally, because at the end of the day, these tokens get listed on a DEX by anyone who wants to provide liquidity. You're essentially paying those who normally would early on make you successful, but you're actually rewarding them early on. And I think that like when you juxtapose that against like the people that have worked at like an Airbnb forever, like there are folks, not the ones like at the very top who have, all of the equity, who are going to get extraordinarily rich. And I think rightfully so, like they've had quite an innovation with Airbnb, but there's a lot of people in the middle, they have thousands of employees. And I'm like, this person shouldn't have to wait 10 to 15 years for them to go public. Like it's nicer to have that liquidity. And I guess this brings me then back to, how do you explain the opportunity of decentralized finance to those who do not know crypto, but then those who, because you work across a wide spectrum, folks that might have only Bitcoin. But anyways, how do you explain?
Okay, so DeFi. Let's say you're talking to a non-crypto person. So you'd say DeFi is sort of banks are comprised of, like, what are the core products a bank offers? Lending, savings, payment processing, security, data, like credit, whatever. Those are like 5 key products basically. Now, if you unbundled those, which is what's happened in fintech, so you've seen TransferWise to do sending money, you've seen Lending Club to do lending, you've seen Acorns for savings, and all these sort of different things. When you put those all together, kind of like Captain Planet or Transformers, when you assemble the team together, they create one bigger thing. And that's kind of like, that's what a bank is. A bank is these products deconstructed. And so, one of the sayings is that banks are going to die death from 1,000 paper cuts, which means their core businesses, the foundations of their core business, which is lending and credit and savings and all these kind of like these 5 or 6 core products, they're getting decoupled from the bank, and people are specializing in it and doing it exceptionally well. And so I would say open finance is a digital currency, the next evolution of those type of products. I'm probably a bad shill. That's a pretty shitty explanation.
No, I haven't explained it like that. I've always like, I mean, like what I just asked you too is a little bit of a loaded question, because you started it with what I think everyone has to learn if we're going to communicate this to the world. You have to ask questions first and understand the person you're speaking with. And so if that person, for those that have a savings account, I'm always like relating it back to that. Hey, you can take your money and you can lend it. And when you lend it, there's no bank in the middle to collect the fees. And so imagine if it's all automated by like a money software. So I lend it, someone else borrows, they hopefully pay a lesser borrowing fee. I get paid a higher lending fee, and it works. It's kind of like, I think Chris Black is the person who first related this. I don't know if he made it up or someone else did, but relating it back to email, that DeFi is very much like email for your money. And you could also even say that like, that's why like Bitcoin as a digital gold, it's an advancement on this digitally, it's an advancement on a scarce asset, and so anyways, it matters.
Yeah.
You think about.
I don't think Chris. I'm a big fan of Chris's stuff. I don't think Chris made that up. I think that's an older one. But yes, it is the case where the protocol is like the internet, And the application on top of it is, well, what can you do on the internet? One of the first promising applications was you can send an email. And so like that's sort of this, you know, sending and receiving value is considered a, you know, an email like application because it's common sense. And when you think about it, like, so here's one of the things I have when, like, the biggest problem I have actually probably with most like DeFi metrics and stuff like that, because I'm a massive DeFi fan. But it's like people are targeting the wrong metrics. Like people are looking at like active users, users. That's like a bank measuring how many customers walk through their door. A bank's a really shitty bank if you walk into a bank and you're spending 6 hours in there looking at brochures. Like for banks, the best type of customer is someone who comes in, spends money or makes a transaction, and then you never see them again. Like that's the most ideal customer. So when people talk about having like active users and like, oh, we got 100,000, 1 million, like that is the worst possible metric. And I wish people, like, from my experience, when I get to work with teams or, you know, just like learning more about the space, it's somewhat frustrating when people chase the wrong goal almost. Because it's like, no, you don't want that. You want to be adding value. You don't want to be sort of compromising. You're trying to fit, you know, fundraising KPIs of the web into money. Now, information and money are very different. So information, if we take the same example, if I go to a library and I spend 8 hours in a library reading books, that's a great thing. That's like a user going to your website and spending a ton of time on site. They're obviously very engaged with the content, which is obviously very opportunistic for monetizing. Now, the same thing, but if you translate that to money, we look at the example, someone coming in and spending 8 hours in your bank looking at brochures isn't what you want. It's that person who comes in, then makes a transaction and leaves. And so I just think about that. And sometimes people are getting the two, they need to just think a bit harder and just like dig into it a little more. But I agree in the premise of like, you know, these applications, like crypto protocols like the internet and the applications on top of it, similar to email, web browsing and stuff like that.
Michael, what do you think are some of the metrics that DeFi should focus on then? Like I can give an example that I think the main metric, like the almighty metric that we think about at Zapper is Zap volume. It's just, it's proof of someone finding value and using us. And to your point, like for us to sit around and beat ourselves up over how many like average users there are, it's a little more difficult to track. It's also, I think, a less of a meaningful metric right now because we're so early. But when you see folks continue to zap volume through, and for that volume to grow, which tends to mirror in our space, it tends to mirror space. Like zap volume went up to its highest point. I think it was early September before the market drew down. And now we're sort of like leveling off and starting to go back upwards. But yeah, what metrics do you think about in DeFi?
I think like that's super important to understand what the goals are. So like, for instance, in, you know, if you're doing loans, you would want to be like the loan repayments. So how frequently are people repaying their loan? If you're doing savings, you want to do, you know, like obviously, well, forgetting any kind of technical risk, but it's always got to be, you know, you're assuming you're secure. Yeah, it depends who you are. So for instance, if I'm Uniswap, I would look at, you know, volume's good, but the real metric that I don't think they look at, or like people around them when they're looking at Uniswap's sort of strength, like these are networks, distributed systems, and in distributed systems, look at how far the tentacles go into everywhere. So for instance, I would be looking at how many of the applications that are all plugged into Uniswap, which is basically everyone that's got an exchange component to a degree. What is the average balance of the average user of those protocols? And so looking at that potential volume, if you think of it like a tree with like with the core protocol, like how far out do those branches go and how many, like what's the weight on each of those branches? And, you know, I look at things like, I look at things like that. I look at how people launch their tokens and who's got control over the tokens. Really good example is people go to launch their governance token on Binance. Like that would be a terrible idea to launch your governance token on Binance because Now, not that Binance is bad, it just means you've got a whole bunch of people that don't really know what your protocol is, but you've got the new blue token, so they're just going to trade it. You've lost control of your protocol. So, yeah, the main things I think of is how well have they defined their KPIs, basically. That's because that's a very hard thing to do.
Yeah,
because if you don't have a it's dangerous not to have a destination. Does that make sense?
Yeah. I have always subscribed to finding maybe like one or two metrics that an entire company or team focuses on. I think it's because in all honesty, I'm not going to pretend like I came to that conclusion. I think like many, there's so much brilliance shared on podcasts, and I've heard all sorts of really reputable founders talk about that, focusing on just a few things and doing them incredibly well versus trying to have 20 metrics that really you would find many of them are correlated. So it's like, what do you worry about all of these? Just focus on that one and everything else will fall in place.
And you know what's funny is that we were just talking about the banks and the banks doing 5 or 10 different things as their core products and people biting those off and doing them really well as one product.
Yeah.
In the same way, it's like those metrics. You can't do 10 things really well. You need to focus on one North Star metric, and that's got to be what everyone aligns around. And it's like with DAOs, talking to people about it, with DAOs that have low voter turnout, people think that's a bad thing. And in my opinion, I'm like, well, not really, because if not a lot of people are getting up to vote, it means not a lot of people really give a shit about what's being voted on, which means either people don't have access to be able to vote, which is not the case, or it means it's not much of a pain point that people feel like they're compelled. And if it's not a pain point, it usually means there's alignment. So that's actually a good thing. The lowest possible voter turnout is probably the best indicator. But if you think about like at Wyre, it's like, you like platforms that we work with, whether they're like banks or they're a DeFi team, it's the first thing you have to understand is what is important to them. So if our company is successful based on the success of our partners, the first thing we need to know is, well, what does success look like? And I don't mean that in like a bullshit kind of, salesy way, but I mean, legitimately, if you're raising another round or whatever, what does it look like? Because you might have 100 million users and you need to make $10 million worth of revenue to get to your next round of financing or whatever it is. Or you might have $100 million in revenue, but you've only got 7 users and you need to get 10 million users. So measuring, understanding what that is at day 0, day 90 and day 180, because, imagine we work together and then 6 months later, I'm like, hey, you made $10 million in revenue. It's like, I don't give a fuck. We're fucked now because we were supposed to make, pardon the language, by the way, but we were supposed to have 100 million users, not 10 million more in revenue. That's not important to us. And so you have to have that alignment because otherwise you can't be successful. And so I think that even understanding what those real KPIs are and having a real deep dive into understanding that, it's not easy, but it's the most important thing you could possibly do, I think. And I know it's going to sound cliche.
No, I think a good example sits outside of the crypto space in terms of focusing on the right metrics. If you look at the U.S. election just having taken place, one of the things that was focused on by both campaigns was trying to get as many people to vote as possible. Now, granted, I would argue that each campaign had its own strategy about who is the person that we need to help vote. How do we better help that person? And so you look at, on the Democrat side, you had more mail-in ballots. There was a focus on growing that. But then on the Republican side, there's still a tremendous amount of education around polling locations, there's outreach to your community. Anyways, that's something over the last, I'd say not just 4 years, but last decade since I've really paid closer attention to US elections to realize, wow, no wonder there's this campaign to get out the vote. It's not just virtue signaling. It's that you want those who are going to be active and to voice, their opinion. You want them to be able to vote. So it makes me think that we always have lots to learn in DeFi governance from like the real world, because governance is hard, and it's all you have to do is look at any government out there, and you know, anything that's a democracy or supposed to be a democracy, and you quickly start to realize like, well, if we're going to mirror that in the digital world, we're going to have lots and lots and lots of issues.
Yes, and I think one of the things that makes it easier in the digital world is that DeFi is like money Legos, right? So we talked about money Legos. Imagine US, like if we took that equivalent, the US election, the whole country is 52 pieces of money Lego. And of those pieces of money Lego, or 50, how many states are there? 52? 51.
50, but then there's like territories, like I think Puerto Rico is considered a territory, and Guam. So no, you're
how many stars on the flag?
50.
Oh, okay, no. So it's not 52 at all. All right, cool. So 52 minus 2 is what I said.
I won't sponsor you now. Now I can't sponsor you.
So basically the money Legos, you know, governance is very difficult. The US election is very challenging, and being like governing a country is a fucking shit show, as we can see, because you've got to do 500 different things. There's 500 different needs, 500 different goals. There's economic policy, fiscal policy, you know, all these things. That's why money Legos are really important, because you have these teams that only know how to do this, and that's one thing. That's the lending person, that's the savings person, that's the UI. Like Zappa, for example, you're the messenger. You route messages to everyone. You're not there to make a CDP competitor. You're not there to do anything other than be the plumbing. And that's your role and responsibility basically at Zappa. And I mean, obviously there's future and stuff like that, but I mean, everyone owning their own domain as experts is better. And this is what was a problem. I talked to teams during crypto winter where they couldn't ride out the winter. And so they rushed to do something else to make some revenue really quickly. And it's like, that's problematic. Everyone, like financial markets are cyclical. They go up, they go down. In a down market, people want X. In an up market, people want Y. Everyone needs to band together and collaborate, because everyone's time will come. So whether you're doing this now and it's not hot, it'll be hot later. And if you're doing something that's hot now, it won't be later. But the key ingredient is glue and composability between one another, so that everyone can be experts at one thing. So yes, some people might experience a tougher time during a bear market, but those people are going to shine during a different market, and they need to focus on what they're really good at to keep that expertise growing and be very narrow in what they're good at, so that when someone goes, you know, hey, let's say Uniswap, there's like, they would be the people who know how to swap shit. Hey Zappa, how do we route between different protocols? Hey Compound, how do we do savings? Hey Maker, how do we do collateral lending or whatever? Like, everyone becomes a master of the domain, and you have a round table of experts. And it's quite literally what happens in governments is you get these round tables of experts. Usually though, they're not picked on merit, or I mean, maybe they are. I don't really know much about politics, but I think it's sort of like, you know, people kind of fudge their way in. But governance is easy if people are very focused on one thing. And so when we all know what the one thing is, each Lego block is focused on, we can all construct this, you know, this Captain Planet looking thing that makes really good decisions, you know, when everyone assembles together. So that's why I think like Bitcoin's successful in the fact it only does one thing. So people criticize that. You can't do payments, you can't do this. Doesn't matter. It does one thing. That's all it has to do. Don't change. It's a mutable ledger. You know, that's all it has to do. The longer it does that, great. And now that might be a boring part of the stack to bite off, but as long as you differentiate the fact that that's its job and you want it to keep doing that as much as possible. Ethereum wants it to keep doing that as much as possible. It's in the best interest of Ethereum. And it's kind of like that understanding that it all ties together. You know, in a couple of years' time, that's what happens. And so I think it's important to acknowledge that, so that people can move on really aggressively towards their KPI and not be bothered by, you know, all the noise around it. I feel like I rambled a bunch there.
Yeah, no, man, this is great. I like, we're covering a lot of ground. No, this is really fun. I feel like we're actually talking through more topics than I've talked through in previous interviews. So this is perfect. So you brought up a point about sometimes Bitcoin gets criticism for doing one thing, which actually it's a few things: a store of value and a transfer of value, and there's value in the fact that it's censorship resistant. But like, I think one of the arguments that does commonly come up is, I think the assumption for many, and this would be folks I think who have the largest stake in Bitcoin, their assumption is that Bitcoin must remain the #1 market cap in crypto.
Yeah.
I guess, does it have to be though? Like, can't Bitcoin be successful and be eclipsed by a platform that does so much more, like Ethereum? And like, we don't need to go down the path.
No, I've got a really great explanation for this. I've got a really good explanation.
Sure.
So Bitcoin's market cap is X, and now Ethereum does all this amazing stuff. It should be more than X, theoretically, over time. As people build more protocols on top of this stuff, it all is sort of coming back to one point, right?
Yeah.
So the way that I think about that is, and it's pretty accurate to think of it this way, like, these digital protocols are proofs of work, which means energy was consumed in a different environment and digitized, basically. So with the mining, right? Now, think about Earth. Earth's a very valuable planet to us because 3 billion people can build stuff that's thriving. Like, if you compare, like, if you think of Ethereum as a protocol as like a digital star, it's like Earth. There's shit going on. It's thriving. People are building buildings. There's lots of population, lots of activity, yada, yada, yada. And you can do a lot of shit. Now, if we went to Mars, we can't really do much shit on Mars. There's not oxygen, so we need gas tanks or whatever. We need like a spacesuit. There's no buildings. There's no cars. There's no roller coasters. So it's not really fun. But in that solar system, Ethereum is probably very much like Earth. But Bitcoin would be like the sun. So the sun is boring. It doesn't do anything. You can't do anything on the sun. It is just a heavy, dense ball of mass that helps transmit energy into Earth, basically. Now, it doesn't mean that the sun is useless, because quite the opposite. If we didn't have the sun, we'd all be dead. So if you think about the utility component of living on Earth, it is amazing, and Earth is the best planet, but you've got to remember that the energy comes from the sun, and we rely on that. In the same way that liquidity and this hard immutability for digital assets comes from a heavier chain that's got more work on it, which would be the Bitcoin proof of work, its job is to be immutable. So, Earth's job and the sun's job is to not turn off, basically, because that's problematic for us. And Earth's job is to be thriving with oxygen and have lots of cool roller coasters and planes flying around and stuff. And they both work together, very much so.
The dad one day, Michael, explaining this stuff, like explanations for it. I like that.
Does that make sense?
I like. I think the one thing I would challenge, which I don't think you're saying, but I think that we could see a future where we're not dependent on that sun. Like, that sun right now, like, I look at Bitcoin as it's an on-ramp for liquidity. It's a household brand name. I mean, just look at Google Trends. Like, Bitcoin, the term is searched like 10x still more than Ethereum and DeFi. I am interested, though, to see, like, over the coming decades. Like, I honestly have accepted that it could be at the end of my lifetime that
will not be at the end of your lifetime, unless you're going to die in 5 years, but it will not be that long.
I'm because there's just so much value that's been built now on Ethereum. Now, 3 years ago did not believe that things were going to roll as quickly as they have. Like, this explosion over the last just 2 years, especially, more notably over 2020, to me, it's just been it's been a huge surprise that it happened so quickly. But it's when you zoom out and you recognize that, like, 10 billion will be laughable when we're at 100 billion. Just like 1 billion to me is now laughable. I'm like, I can't believe we were so excited for that. And now I'm looking at 12.5 billion total value locked away, and I'm like, we need to go that much further. We need to keep tokenizing Bitcoin. We need more financial applications. We need, frankly, like, we just need to educate more people. At the end of the day, like, the infrastructure is there to support so many more millions of people using DeFi applications on Ethereum, but we need more people to recognize how to use it and to be able to pay the transaction fees. That's a whole nother conversation.
Yeah. Okay. So I agree with what you're saying. And when the sun turns off, and like going back to that premise, right? I think it's really important to distinguish is that if you think who these protocols are for, then probably not for humans as much as they are for machines, where like people can trade, but after you start trading a lot and you're yield farming and stuff, you create these autonomous versions of that. So look at YFI, which is, or like, that generates yield and it does optimal sort of like, doesn't it? I think it does, doesn't it? Where you,
yeah.
So that's sort of, it productized, alpha seeking, let's think. And so it's like a machine that is doing it. It's autonomous. And that's the whole principle of this ecosystem is programmability, which means set and forget. So the incumbents would be, someone would know the market and they'd make a bet. Now it's sort of, I'm going to go to bed and my capital will get locked up and lent out for anybody that gives me these assets that I'm willing to accept. And when I wake up in the morning, it's going to be back in my account, but it's been working all night across the world, across all these protocols, because it's autonomous money and autonomous finance. So when you think about that, machines operate on binary, like yes or no. That's what machine doesn't, you can't tell a joke. You can't say, what do you think? Maybe, yes, no. Machines are very absolute in that it's a yes or a no, and there's nothing in between, which is the opposite of humans, obviously. So when you have that, immutability becomes a thing where Ethereum had a hard fork, let's say 5 or 6 years ago, I think it was, or like 4 years ago. Now, when if I tell a machine to do a job and record it on a ledger that hasn't changed, if it had 2 copies of the same ledger, but this one changed once before, this one has never changed, this one is more secure and absolute. It doesn't mean that this one, like the other one, is bad. It just means for the machine to do its job correctly and as absolute as possible, it needs the hardest ledger possible. So that's why I think a lot of stuff is, if you think of Ethereum as being the house, Bitcoin would be the ground that the house was built on. If that's not rock solid, then the house can't be built. And in the same way, when machines are doing a lot of stuff, they're going to put snapshots onto Bitcoin because of its immutability. And they all sort of work together in that regard. So, but I do agree with what you're saying is that you become like self-sufficient in that, the sun might burn out and you don't need the sun anymore, but we're okay because we've got, natural thing, like we've made our own stuff. So anyway, it's a bit like sci-fi, and that'll come in time. But I think it's important to recognize those opportunities as you're building, because you can build for a stronger, more resilient protocol over the long term if you take those things into consideration.
I mean, the best thing anyone can do is enjoy the ride right now. I mean, I'm bullish on obviously all of DeFi, and I'm literally, I mean, you can't put more skin in the game, literally working in it and putting your money into it. But with Bitcoin as well, like I see Bitcoin and DeFi built on Ethereum and everything else built on Ethereum. I still see it as complementary. I definitely, though, have grown increasingly more confident in 2020 that Ethereum is really sort of, it's rebuilt a new house, a new foundation where ETH can be the store of value asset. But like it would be crazy to be ignorant to the most liquid crypto asset in the world, which is Bitcoin. So like, why not harness that and use, like the Ren protocol, or use Curve's pools, which are by the Ren protocol, to tokenize Bitcoin. We all sort of like win together in the end. Can you tell me what do you think is? So you're a founder of a crypto related company, but you interface so much with DeFi founders, like let's say like Kane from Synthetics. Do you see a different like archetype there in terms of the folks that are building in DeFi? Because I feel like, again, you as a peer might recognize like what's similar and what's different about being a founder for one of these, let's say, blue chip, more liquid DeFi protocol.
I find like the founders, the blue chip ones, always pragmatic. So Kane, very just realistic. Like obviously you've got your principles, but they get that it's not a this way or the highway, because that's jeopardizing their own success. And so if you look at like how Synthetics has operated, they've iterated, they've rebranded, they've understood like what people want, they've changed their dynamic a bit, they've had this pragmatic approach to the DAO and like Synthetics, you know, improvements and all these kind of things. And I feel like they've been a really good voice like that. MakerDAO, same thing. Like they've been very pragmatic. They've been speaking to, you know, listening to the community. The community has been very supportive because, like, I mean, for the most part, obviously they've had challenges, but you graduate to these problems. Like no one's hit the marks that they've hit before. And so I think it's very easy to look at the problems as negatives, but I think it's actually a milestone that they're hitting the problems. The like being pragmatic in the mindset, and I
like that.
I would say
a good point. Yeah.
And I would say humble. Humility is probably the best. And here's why: like confidence, but humility in general in networks is you have to have that. If you don't have that, you're dead. Like there is a 0% chance you will succeed. And I'll tell you why. Because humility helps you empathize with humility and empathy, basically. But being humble means no one knows what the fuck's going to happen. So when you don't know what's going to happen, you need to be humble enough to say, oh shit, we're wrong. We need to adapt. And you need this fast feedback loop. So it's like, it's not about moving the fastest. It's about acknowledging the faults the quickest. Let's imagine I'm on a game show. You're the host and we're playing Price is Right. And there's 3 doors. Behind one of them is let's say there's 100 doors. Behind one of them is a car. Behind 99 of them is dog poo. Now, you would assume all of them eagerly. Yeah, literally, it's a shitty game show. No pun intended.
100 doors. One of them has dog poo. You have to eat the dog poo if you open it up.
Every door you open with dog poo, you've got to eat the dog poo. No, but let's say it's not important to let's say you have to open, the person who opens the most doors will find the car the first, right? Like who opens the door the fastest. It's actually not about who opens the door the fastest. It's who opens the door the fastest and can realize they're not looking at a car. Because if you're blind, you can open the door, but you don't know if there's a car there or not. Otherwise, you'd be smelling dog poo. But do you see what I mean in that you need to recognize that it's not correct so you can move on. The faster you can do that, the faster you know your faults and be wrong. I'd say humility is a very, very key attribute that it's just common in being like in success in unknown. I'm just plugging my charger in because my computer's yelling at me. It's the most common attribute in success, at least from what I've seen, is that especially with uncharted territory, you need to know you're wrong. If you never think you're wrong, then you can't change and everything just changes around you. But you need to be able to say, I'm wrong, fix it, iterate, rinse, repeat. And that rinse, repeat, and that feedback loop is clutch. And I think the people that do it, I think teams that are humble by nature or I think teams that are humble by nature, I feel like they're the most successful. And you got to remember, it's like these are networks that can't go backwards. Networks aren't like startups, which, you crack the whip at the top and it trickles down to the bottom and they change or they pivot. Networks, they start flat and they remain flat forever. So you need to get it right, or you need to work as a network, which means taking feedback in order to be successful. And if you're not, these networks fracture or they splinter. And the strength of a network, its resilience, comes from interconnectivity between one another. So when you have two things split off, it obviously weakens. So, yeah.
Can you think of, Michael, a time when you discovered that you were wrong and that you pivoted with Wyre? Like anything that really stands out?
I am the most wrong person ever, always. Like literally, I spoke at ETH New York in last year, and it was literally the whole thing was about crypto winter. It was like, I literally did a whole presentation on how we got it wrong and every example that we fucked up. But we were really quick.
What are some of the examples? Like, because I think we
payment processing. So we did payment processing. We did a whole initial, and if you type in integrate SF Bitcoin, like the company was called like Wyre before it was called Wyre, it was called Snapco, and that was where we literally we ordered. We were merchant processing, and we felt like, okay, we've got to help enable everyone to be merchant processors, Bitcoin and Ethereum, Litecoin and Dogecoin at the time. And it was like, we wanted to get everyone on board. And so turns out no one wants it. Like literally no one wants payment processing for Bitcoin because everyone's making too much money from it. So whoops, that was wrong. I mean, not no one, but I mean like the general rule of thumb now is different to 2014. Where else were we wrong? We were wrong in doing shit. There's so many, I can't even, I literally am puzzled. We were wrong in I know. I'm trying to think where I know I've been wrong in a million places. I'm trying to think of specific examples. I'll post you the picture. I'll send you the picture of it actually.
I think it's hard to know though when to be forthcoming and willing to admit that you're wrong versus like holding to your convictions and believing that you can do something. Like there is definitely a tendency in the crypto community, and I would say namely like Bitcoin. It's like, this is the way the world is, and we're going to believe that until the end of time. Whereas with Ethereum, the ethos is so different. It's the community as a whole is very quick to say, I don't know what I'm talking about. I was wrong, and we're pivoting. And then that's almost seen as like a weakness, let's say, by someone who says, listen, like all I want to focus on is empowering Bitcoin as a store of value and as a censorship resistant global transfer of value. So struggle with that, and I don't know if that's a reflection of like my buying in to ethos on both sides in the community. Like I question everything too. Like I'll do a tutorial on something and it doesn't get as many views, and I was like, well, clearly no one gives a shit about that topic. I'm not going to cover that again. And then I'll get a message from someone saying
they got a lot of value from it.
Thank you so much, and I'm like, okay, maybe I should zone in on that. So you know,
I mean, and this is where it comes back to. So if you're doing a store of value, then changing and iterating and moving fast and breaking things is a horrifying thing to that person. Like if you imagine personifying it as I'm the paranoid person that doesn't like change. Imagine you've got a group of friends, the person who doesn't like change, and then you've got the crazy person that loves just being sporadic and spontaneous. Those two give each other a heart attack. I think of Ned Flanders and Homer going to Las Vegas, and Homer's like walking past tables, just throwing money on tables. Ned Flanders is like, oh, fuck, like, what are you spending your money on? He's like, I don't know. Oh, and he loses it all. He's like, all right, let's go get a beer. And it's like, what the, like, so if you think about personalities, like each chain having their own personality, which comes back to their goals and their KPIs, Bitcoin doesn't change, then obviously if that's its core competency, which it is, and then, you know, then someone who's changing all the time is a horrifying thing. And vice versa, someone who's changing, exploring and being adventurous, looking at something that never changes, then that's sort of, you know, a horrifying way to be as well. You know, like having a vegan friend and you're like, what? How do you never eat cheese? I literally eat cheese all day. And they're like, how do you eat cheese? You're just talking past each other. So there's like the conversation's probably like, it's not that productive to even entertain to lengthy degrees, in my opinion. No, it doesn't mean it's right or wrong, but
calling out listening to others, like this is part of the reason, like I do enjoy following people that I strongly disagree with, as long as they're like respectful. Something that we
mature enough to have a proper like discussion about why, or
I learn a lot by following different folks with different opinions. Michael, I just want to be conscious of time, make sure we don't hold you over too much longer here. So I could.
I've got plenty of time. I've got 2 hours.
I was going to say,
you're like, dude, I've got to fucking go to bed.
No, it's funny, I realize there's so many questions I hadn't even asked you about because we've organically run through so many other topics, which is perfect.
Yeah.
Tell me, do you have any theses on how the pandemic is either good or bad for crypto and DeFi? Like, I think one could clearly discern that over the last like 12 months, there's been a lot of, I mean, just look at prices and you could say, well, I would argue that's proof that it's clearly been somewhat good for our space. But then at the same time, I think like today there was a vaccine that's promising from Pfizer that was announced. And I wonder, like, you know, for a market that is super, super reflexive, you know, where we easily overshoot values going up and we easily overshoot them going down. Anyways, what do you think of like the coming effects of the pandemic and eventually a vaccine?
Yeah, I think the pandemic's taken effects for sure. I think it's already had effects. Looking at what happened during the pandemic. So what did happen? People had to stay home. People stayed home means they're not going out. They're not socializing. People buy and spend a lot of money socializing. They buy the new T-shirt, they buy the new watch, they go out and have beers, whatever it is, right? Disposable income goes out. And typically that can be correlated. Well, I mean, sorry, maybe not, but you know, it's people have debt, people have credit card debt because they go on holidays, they buy things that they don't really need. They go to spend a bit more extensive with their spending. So one of the things we saw was debt getting paid back. People using this as like oh, fuck, yes, now I can't even go out and spend more money. So I'm going to pay back my credit card loans. I'm going to pay back my Afterpay. So Afterpay's numbers, lots of people repaying their stuff because people have money because they can't do anything. Nowhere's open to go. And if there is open, then no one can go with them. So this disposable income kind of went up a little bit, or debt probably got cleared a little bit. And I think you can see that in like the lending platform numbers and how people were paying back debt. So the pandemic's kind of good in that it gets people to pay back debt and not spend as sort of like Yahoo-y, because, you know, like whatever the term is, like recklessly. Not everyone, obviously. So I think like what's coming is, I mean, there's a monster that's like the biggest thing on earth coming in terms of bull markets, but I don't know if the pandemic will have a very longer term effect. Like, I mean, sorry, right now, like over the next like month or something, vaccine, no vaccine, I don't really know.
It might be
but it's all
short term to be thinking about it. You know, at the end of the day, like I've always been just a long-term investor in the space, and you know, I participate in DeFi protocols where I can earn rewards or like interest, and then just try not to look too often. You know, every hour at a portfolio on Zapper, and track it up and down. A follow-up to that is, do you think that token prices have to go up in order for us to be successful in DeFi? Like we've talked today a lot about, we've actually talked a lot about prices and the market and sort of these bull run cycles. It's something that you separate from like building in DeFi or crypto, because most of the teams, like including like a Zapper, like, you know, you get funded by digital assets, which some of the time are volatile. So like, can DeFi be successful without these bull and bear runs, or is it something that must continue to happen? Like will we, for the rest of our lives, are we going to have a heart attack every like 4 years and watch the market?
Well, I mean, and the heart attacks are all relative, right? So the heart attacks are relative to someone who got in at 400 and it drops to 200. That's a heart attack. But for someone who got in at, you know, $80 and then ETH went to 400, now it's back to 200, Heart attack is less so.
Yeah.
You know, does everyone need a token and stuff? Look, I mean, I feel like that is probably, I think there's good ways to do it, and I think there's bad ways to do it. A lot of the people use the token as their stickiness, which is not really good. It's kind of like in that yield farming kind of component where it's a short-term incentive to rope everyone in, right?
Right, right.
That, if you have to use that to get people there in the first place, that's usually a bigger indicator that something fundamentally is not appealing to the platform. So Zappa at the moment has I would say, a pretty compelling, you guys have a very compelling product offering. And that people come there to, you solve a problem for people. Now, if you add a token on that, that's a different story. Uniswap, they were a very compelling product for a very long time, and now they're adding a token. So it feels like, it's not my opinion. I mean, sorry, it's just my opinion that if you can build a compelling product offering without the need to financially incentivize people to use it through means of a token, right? In the immediate term, you will be more successful long-term fundamentally because you are adding more value. Someone who's willing to come to use your product without you having to give them a coupon code or a discount, which is sort of like what tokens can be like in a yield farming perspective, has a higher probability of success almost every day of the week. It also removes any risk of liquidity management. So when markets are super volatile, your asset is most likely going to be illiquid because it's a brand new product, which means it's going to be super volatile. So now you need a market to solve that. You need to be getting people to focus on that. A lot of the time it's a distraction. Unless you've proven product market fit prior, I think it's probably not the right way to channel energy. I think Uniswap and Zappa and Curve are probably good examples. Curve's got a tremendous value proposition. Uniswap's got a tremendous value proposition. Zappa does. Compound does as well. I don't know if I like the way that they've done the liquidity mining stuff, but it's all good. Trying is better than not trying, you know, in everything almost.
So do you still then believe in the utility of the token being used for governance? Because I think we know at the end of the day that there is a financial incentive there, clearly, no matter what anyone says, because those tokens go up on a DEX and the market, buyers and sellers, decide what the price of it is. And in many cases that, you know, if you can get into that token early on, or at least teams that issue them, the teams issuing them can clearly become very wealthy for them. I guess, does that diminish the value of governance that we originally thought these tokens were meant to impart?
Two really good examples. EOS, right? EOS listed on a bunch of exchanges. That means each token, that's a governance. Like, you can't vote with that. I mean, sorry, you can, but like, you've got all these people that are just throwing it around. There's a very deliberate reason why MakerDAO, the way that they released the MKR token, was super organic, which is you've got to be contributing on the forums or anything like that. Like, they didn't do an ICO. Contrary to what people think, they actually weren't an ICO token. They were the first, I think them and Augur were the first tokens on Ethereum ever. And that is like such a way back, that like a long time ago, that when you think about that, the release schedule of them was very, very like squeezed with MKR. So you could only get it if you were contributing on the forums. Like, I don't know. But the main point I'm trying to make is that they had control over how it grew, in a sense, because they're nurturing it. It's like, imagine if Satoshi Nakamoto built Bitcoin, and instead of posting it to the cryptography forums and stuff to getting a like-minded alignment of people on, he said, oh my God, I've made irreversible digital money. I'm going to go to every porn site and every gambling site, and they're going to love this. It would have grown in a far different way. And so I think that's really important, is that curation where you control, like, you're growing a baby. Like, I mean, you don't have to touch your baby. I'm sure it's going to survive and figure out a way to live, but you want to nurture it in the right direction based on your values and what's important to you and how you want that baby to grow up. In the same way, a DAO needs to be the same. Now, if you want your baby to turn to be a professional at 20 different sports, it's going to be highly improbable that you can get that done, but you might expose them to 20 sports. Think of that as KPIs. So you want your DAO to be good at 20 different things and your protocol to do 20 different things. It's unlikely you're going to get your baby to be a professional, like Shaun White, professional snowboarder, professional skateboarder, mix in some Tony Hawks and Matt Hoffman, whoever. It's not, no one's getting set up for success. So you try and encourage them to find what they love and do that really well and passionately. And so in the same way, protocols need to find that too. So governance tokens need to be very well thought out. They need to basically be very simple. The more complex people try and make them, the less successful they'll be and the less valuable they are too. The easier they are to acquire, you should have to work for them. Like talking about, protocols where you have to get them through word of mouth or through, doing work for the protocol and stuff. Otherwise, it's a ticking time bomb. It'll last. It won't last. Yeah.
Is there
less?
Is there an example of a governance token that you think is well designed? Like which ones are you?
Maker.
Okay.
Maker DAO. Yeah. And I'm like sort of biased on that, but I mean, it's pragmatic. Like, no, it's not perfect. It's not supposed to be perfect. If you're expecting perfect, you're going to be waiting a long time. It's the best at what could be done at the time, and it's incredibly successful. Now, defining success for most people with a governance token, they're like, well, how many people turned out to vote? It's like, that's the shittiest metrics ever. Like, how happy and how successful is the protocol over the long term, and how many votes have you had? Like, MakerDAO is very successful in my opinion, in that they've survived they've weathered a lot of storms. They're coming into a bull market. Now, if people aren't turning out to vote, you need people to know how to vote. But if people aren't turning out to vote, it doesn't mean it's not successful. It actually probably means the opposite. So for me, it means that there's not a big enough pain point for you to get out of cold storage, go figure it out. Because if I say like, hey, they're making a change, like, you're like, yeah, it's like not ideal, but it's okay. I'm not really bothered by it. Like, it means you're still aligned to this kind of core goal. It's a very, very powerful indicator. And the longer that happens, even if it forks or something like that, it's still gone on incredibly long. Like, you've got to remember, this is quite literally run. You got multi-collateral DAI that launched. You've got all these new collateral types. It's all community driven. And the community that it's got is a community of people that were interested in a very organic way. As opposed to sort of, hey, we came for the 500% ROI. Where's our money? Like, there is no DAI savings rate, but that doesn't affect DAI in and of itself that much. Like, DAI is still a monster. And that's because people aren't there just whoring out themselves for the savings rate. They're actually there because there's this very powerful utility. Savings rate is a cherry on top that will come back. And so I think that's quite important to determine the integrity of the audience or the users that you've got. Does that make sense?
Yeah, I'm looking up here on DAIstats.com. There's 957,000 DAI that's been issued as of today. So we're just under, 957,311,000. So we're just under a billion. It's crazy. I mean, I remember when it was way under 100 million and under 50 million. How about, Michael, though, how do you respond to, like, there's criticism of Maker that, it's very centralized, that, there's large holders of the token. And I'm saying this too, as someone who's I'm a big proponent of DAI. I mean, Maker to me it's the granddaddy or grandmother of all DeFi applications, and it continues to be one of the most important. But it's interesting to me, like, I've always been impressed by the governance, like the participation on those calls, the rigor of thought that goes into each vote. But then I also recognize that there is this, I think, this criticism And I'm wondering, like, how do you explain it, or is it just like it was a different time, and I guess the community was smaller then, and now we've grown and more people could stake in Maker?
Yeah, I mean, it's so in what point specifically are you talking about? You're talking about like the fact that the team's got a large amount of MKR or something?
Yeah. I think the criticism is I don't even know the exact numbers, but there's a number of VCs that invested early and they've got a large stake in it. I mean, I've argued this with friends that, like, I mean, there's a lot of money at stake, so they have skin in the game to act with the best interest of the protocol. But then, of course, you take the other side of that and say, well, is their interpretation of what the best interest is for the protocol, is that truly what it is, or is it just for them? And I mean, I don't know. I guess I'm like, I'm a more.
I know what you mean. And I think it's important to think, like, so the VCs got in at $300. A lot of the VCs got in at $300, and that was at Andreessen. That was the end of 2018. That was Andreessen, a couple of others. I think Wyre invested. Polychain. Well, Polychain got in very, very early, but they're a VC. But if you look at what they are, they're not a VC. They're a crypto native fund. They were the first crypto native fund. And so the VCs that might have an alternative agenda coming in from a traditional market, they would probably be the ones that people flag a little more. But at the end of the day, like, they came in at $300. Polychain came in at like $5. So Polychain is going to have a way bigger vote. And every other community member that's involved came in a lot earlier. But to me, like, if you've got a team holding a treasury balance and it's not in their native token, I feel like that is not as good of an indicator as if it is. Like, imagine if you're like, hey, I need you to come and buy DeFi Dad coin. And I'm like, okay, cool. And you're like, yeah. I'm like, well, what do you use day to day? And you're like, oh, I don't use DeFi Dad coin. I've got US dollars in my bank account. I sell it. Like, if you were like, I live on it, like, it's the only thing. Like, so if they keep their treasury the way they, like, I don't know the ins and outs specifically of the treasury, but I think their confidence in what they're doing and this very realistic, pragmatic approach to creating value, which they have, is super important. Even from like a regulatory standpoint, like, if you've got a token that captures value, which is what MKR does through the buy and burn, like, you can grow to decentralization. Now, if you are constantly propping it up, manufacturing the value with this token, it becomes like a one-oared boat. Like, you're just rowing, and you'll row in circles, basically, because you can never, you're always kind of fudging it. And so, like, having this buy and burn and this governance and sort of the way that they've approached it, it sets it on a good path forward to be decentralized and fully community operated. And I think that's sort of part of the goals for the company, or like for like the protocol over the next, let's say, 18 months, is to get to that standpoint. And I think it's super ambitious, and I think it's super awesome that they think that way.
Maker a really impressive team to me. I still, like, just, foam at the mouth seeing all of the volume or all of the value that gets locked up in Maker. And it set a precedent. It definitely demonstrated to us, like, that, hey, these money Legos will work. I remember hearing about DAI for the first time. It was back in 2017. I was brand new to the space, and I just was like, what the hell is this? Like, that's the craziest idea ever. Like, smarter people than me, thankfully, had seen this finance. They'd seen these mechanisms work, and string it together as a decentralized protocol, to me, is just mind-blowing. Michael, I have one last question for you. So if you were to go back in time, with everything that we've talked about today and all that you've learned, building Wyre, like putting a lot of skin in the game in terms of Bitcoin and DeFi and Ethereum, what would you tell yourself? Like, what do you think are some of the lessons that you would want to impart to young Michael 5 years ago So, Michael,
yeah,
in late 2017, everyone's going to tell you that Bitcoin's to $1 million. You need to
basically
go to an island and stop building. Just go to an island. You're never going to get out of here, Michael. No, what would you do?
No, I think shit. What would you say? So it's not that clear cut, and that's sort of funny because I feel like each lesson was so incremental in being wrong. Each wrong was so incremental, it added it up. But I'd say, don't stop, keep going. Yeah. That's the only thing I could say to myself would just be keep going, because it is extremely hard to be resilient through so much ups and downs. Now, like I've been fortunate enough to take some time off at the moment because it's been a really long time, for like 6 or 7 years in crypto, which is like, it's like being strapped to a rocket ship for 7 years. Your brain, you need to rehabilitate your brain a little bit. So, but I mean, I'd say keep going, because that's what every person needs to be told. Keep going, because it's so easy to look for a shortcut, to get tired, to drop out, to think it's not worth it. Keep going. So that's what I'd say.
I like that. I think that it's advice that can be given to anyone. You don't need to be a founder in DeFi. If you are someone who is trying to save, 100 DAI with Compound, and you have a failed transaction and you just think that the Compound protocol stole your money, which happens to so many people. People failed transaction and they think that their money's gone. It's not. It's just a failed transaction. And you have to just continue to learn. Just keep learning, because I'm amazed how much I continue to learn about these applications despite all the time I spend in them. I'm just like, oh my God, there's one more hiccup to warn people of. There's like one more thing that people need to learn about. I want to remind everyone, to follow you on Twitter here at Michael Dunworth1. They can try Wyre, or if they haven't used it in one of those DeFi applications I mentioned, there's so many. Just now you know who's behind it. So you can check them out at sendwire.com. Michael, anything else folks should know about you? Like, where do you get your hair done? Where does that beautiful
I don't know. I just got out of the shower, but I don't have any gel or anything.
I've always wondered that. Is that a natural thing, or do you actually style it that way? Because it looks like
it's like tough. It looks like a toupee almost. No, I've got like one of those gray thing, like this gray patch in it, like Rogue off X-Men.
Well, you can't see it on here, but like I am definitely starting to get some gray hairs in my beard, and my hair is so dark and thick, but like I am like my kids are gonna see me all gray for sure. So you're big fire,
You're turning into an Ethereum logo.
Yeah, an Ethereum logo. But yeah, anything else you think folks should know about to keep up with you, or just to follow the work you do?
I mean, if anyone hasn't tried it, try Zapper. Like, quite literally. I feel like so many people will probably end up seeing this. People will see this at some point that maybe haven't tried Zapper before. It's literally like idiot proof. And I know that because I use it and I'm an idiot. So it is spot on. I just feel like it's so underestimated. Just trying it. Yeah.
Kind of crazy that I was thinking about today as I was just prepping for this is I'm like, we really have a Wyre on-ramp on Zapper, because most don't realize we connect to your wallet, we show you your DeFi portfolio, and that's easy and simple, and we never custody anyone's assets. Zap are a whole nother part of the value that we offer, because you can shuttle money from point A to point B, and we do a lot
routing it
under the hood. A lot of routing and optimizing your money to be in different DeFi protocols, earning interest, or making fees. But everyone does need to convert fiat into into crypto at some point. And I'm just like, I was like thinking about like.
So I spoke to Nodar about this actually. I spoke to him about it earlier, like I think a while back, and we actually have a ton of stuff already done with Zappa at Wyre, which, but I mean, for on-ramps specifically, so it was one of those conversations where it's like, yes, you can add it, but I think there's things that you could add that are going to be more valuable to you guys. Like I could say, yeah, add it, like add on-ramps. But I think like one of the target demographic for Zappa at the moment is much more of I've used this protocol before, I've used that protocol, like a bit more experience, like they've got a crypto balance that they're trying to do something with. So I feel like, I don't think it's like out of the question or like I'm against it. I just think it's actually in the best interest. It's a cool novelty, I think, but it's probably not something that would capture the most amount of value for the target Zappa user. Maybe it would.
Even like Pull Together was quick to implement Wyre, and I always thought like they really cater to a very beginner audience, despite many of us, just keep some money in there because we think Pull Together is cool and we want to see it succeed.
Cool together.
Money. Yeah, cool together.
Yeah.
But cool. Well, Michael, thanks so much for your time. I want to remind everyone that tomorrow we will interview Super Fizz, who is a beloved Ethereum community member. He's going to talk us through a bunch of ETH2 staking. So yeah, make sure you subscribe at tv.zapper.fi. I'm going to take us off air, and then I'm going to go have like a girls chat with Michael in the green room. But thanks everyone for joining us. And Michael, thank you again. Just super fun to get to talk with you about.
No worries.
Great topic.
Thanks for having me. I appreciate it.
All right. Bye, everyone. Have a great day.